Top story, of course, India's gross domestic product or GDP contracted 7.5% in the July-September period as the economy rebounded from a record slump of 23.9% in the previous quarter due to the slowdowns caused by the coronavirus pandemic. While the GDP reading for the second quarter of the current financial year, which is not as bad as the 8.6% contraction that was predicted by global analysts, today's data confirms the economy's first technical recession, which is 2 consecutive quarters of contraction in GDP, the first since 1996, which was when India began maintaining quarterly records. So for more on this, let's go across to Mariam. So Mariam, these figures come on the back of a nearly 24% crunch in the officially recorded first quarter of 2020-2021. Though that said, today's figures offer sharp enough contrast for some of our gloom to lift. What's the main takeaway that you've seen after studying these figures?
Yes, Sarah, so you are absolutely right. This is sort of historic because this is the first time that India has had a confirmed technical recession. That is, 2 consecutive quarters we have seen a negative growth in GDP. But from a minus 23.9% contraction in the first quarter this financial year, we're looking at a minus 7.5% contraction in the second quarter. So definitely things are looking a little up, even though we're still on a negative growth rate right now. Last quarter, only one sector had seen a positive growth. That's the agricultural sector, which had seen a 3.4% growth. Agriculture has held steady this quarter as well and has also recorded a positive growth of 3.4%. But what's interesting is that 3 out of the 8 sectors this quarter has shown a positive growth. This includes electricity and utilities, which have shown a 4.4% growth. Agriculture, as I mentioned, a 3.4% growth. And most importantly, manufacturing has also seen an uptick. It has grown close to 1% by 0.6% in this quarter compared to the same quarter the previous year. What's also interesting is that there were multiple forecasts that were given for the GDP growth rates before the numbers actually came out, including RBI's estimation that the GDP would shrink by about 8.6% in the second quarter. But those numbers, right now, the number that has come out is looking slightly better than what was forecasted earlier. But for this financial year, some of the latest forecasts include that this financial year will still see a negative growth in GDP, and the ranges range between 6 to 10%. Goldman Sachs says that this financial year will contract by 10.3%. Moody's says that it will contract by 10.6%. Barclays says that it will contract by 6.4%. So that has to be we have to wait and watch what actually happens in the Q3 and Q4. In fact, the chief economic advisor during the briefing said that he's cautiously optimistic because there is still a lot of uncertainty involved because of the pandemic. Now, if you look at a global scenario, where does India stand amongst its neighbors and other contemporaries in the world? We have some of the numbers available for some of the countries, which we'll be putting up on the screen. India has contracted by minus 7.5% this quarter. That is definitely better than that of Mexico and the United Kingdom. Mexico had contracted by 8.7%. UK GDP had contracted by 9.6%. But we are still trending towards the bottom of that list. China, one of the only countries which has seen a positive growth this quarter, had grown by 4.9%. So we'll just have to wait and watch what actually happens with the 2 more quarters to go to this financial year. What will it bring?
2 more quarters to go. Thanks so much for that. But it is now official. India's economy has entered an unprecedented recession in the 3 months through September. But are we on the road to recovery finally? For that, let's go across to Subhash Garg, the former Finance Secretary and Secretary of Economic Affairs. We also have Dr. Pranab Sen, a former Chairman of the National Statistical Commission, joining us. Mr. Garg, to you first, certainly some good news for the COVID-ravaged Indian economy. The contraction continues, but it's narrowed significantly, mainly due to easing of lockdown restrictions, the rise in demand due to the festive seasons. But is the worst behind us?
See, it's always relative sense you get. Otherwise, 7.5% is also a terribly bad growth, negative growth. The numbers which have come up suggest that the maths is not actually adding up completely. The most surprising number, which is the manufacturing growth positive, is coming, but we have seen in the September quarter, both the months of July and August reported very large negative growth in the IIP and the core industries index. So that is a very surprising, it looks very unlikely. The other one which is not getting reconciled very well, while consumption, which was expected to be getting more normal, still is about 11.5% negative. But the capital formation is only 7.5% negative. Capital formation has been quite bad. So in my sense, the numbers don't seem to be adding up reasonably well. We might see a lot of revisions, and there are reasons why this kind of numbers can come up.
All right, so it's all relative, but the numbers not adding up. Let's get into that a little bit. But first, Dr. Sen, let me ask you the same question in a sense. Whatever said, it is better than what the consensus expectations were, right? So does this reinforce the view that seems to be supported by several data points that we're experiencing a wrong economic recovery? Or would you agree with Subhash Garg that some things aren't adding up, or it's too early to tell?
The two very different questions. In the first place, these numbers are worse than I had expected. From the consensus, yes, the consensus was -9 and it's clocked in at -7.5. My expectations was closer to -5. And the reason for that, the reason I had a better number, was that I did expect very strong stocking up to happen for the festival season and then the festival season itself. Now, apparently, it hasn't quite gone out, but in manufacturing, it seems to have happened. But if you really look at the numbers, I think there are a few things which are noteworthy. The first, of course, is that manufacturing, as Mr. Garg has very rightly pointed out, is surprising given what the IIP figures were. But we need to remember one thing, that in the quarterly estimates of manufacturing, about 75% is accounted for by the corporate sector, where the data does not come from the IIP at all, but comes from the corporate balance sheets, from the submissions to SEBI. And the IIP is used only as a proxy for the informal sector. Second is that there is a compositional problem in the IIP, which is that the IIP measures all manufacturing production, including the inputs. And what comes in the GDP estimates is only the production of the final goods. Until you look at the breakup of the IIP, you will not have a sense of that. But the surprising part of it, really, to my mind, was the very, very poor performance of finance, the finance sector, finance and real estate sector. We know that construction may have been affected, although the construction numbers have been positive, but the real estate market is still in the doldrums. And but finance seems to have done very badly. This is actually pretty serious, and people have not been noticing this, and I don't know why, because what it suggests is that the net interest margins of the financial sector have been eroded in the second quarter, and finance has done worse in the second quarter than in the first quarter. Right? Which means that it's actually going against the trend.
Okay, so this certainly is worrying, because between Subhash Garg and Dr. Sen were saying that consumption demand hasn't been as much as you had expected. Manufacturing figures perhaps questionable. The finance sector, real estate also not doing as well as you had expected. So Subhash Garg, to go back to you, and is this worrying? Because much of this recovery is driven, at least that's been reported today, has been driven by pent-up festive season demand. How much of it is underlying, and could this recovery run out of steam in the next 2 months? Because you're already saying that there wasn't enough demand.
See, the second quarter demand picked up because the lockdown was unrolled and the festival demand came up. I do get a sense that this demand will peter out slight bit, but not much. It is already getting reflected in November in electricity consumption, etc., which has gone down to lesser than last year. But I believe the demand will hold up. The consumption demand will hold up. It will not go down very much in times to come. The investment demand will continue to be low in my judgment, and that is where the bigger hit into the economy will come in the rest of the year as well. So at the end of the year, I still feel that we will have a contraction of about 9 to 10%.
At the end of the day. All right. And Dr. Sen, lastly to you, how does all of this expect to play out given the COVID numbers in India right now? How much risk does a further deterioration in the COVID situation pose to a recovery? I mean, given that our governments have basically ruled out locking down.
Well, the central government has ruled out a national lockdown, but that doesn't necessarily prevent state governments from locking down, and it's been happening in various places. So that is really an imponderable. We don't know, because as you rightly said, it's not the COVID in itself which has been leading to this economy, the crisis in the economy. It is really the policy response, which is the lockdown, which has been doing it. So we really can't predict. But the important issue is that along with the disease management problem, lockdown or not lockdown, what are governments doing in terms of holding up demand? And the numbers look very, very, very worrying because public expenditures are down. So if you look at government expenditures in the numbers, they are seriously down. And we had expected that these would actually go up. Now, if this particular feature continues, then I think we should be looking for a downturn in the third quarter.
All right. So clearly, it's going to be a long way off to recover. Certainly to the point that we were before the lockdown was announced. So it could be a long, long way ahead till a full recovery. Thank you both for joining us tonight and helping put all these figures into context. Thanks for that.